Good morning, ladies and gentlemen. We start this week's review with the US fixed income market as usual, and here we have a chart of the yield of the 5-year note. We can see how well it has respected the 200-day moving average and how last week it just broke higher and continued to break higher. What are our expectations? Well, it is moving quite fast. It is opening up the Bollinger Bands from this contraction. So it is probably in trend and we wouldn't stand in its way. We are probably looking at a test of 2% in terms of yields in the next couple of weeks. We don't think the move is going to be straight there. We shall probably try to do some backing and filling around the 185 to 180 area before breaking up towards the 2 area. We don't foresee a major trend starting from here, simply because we don't see anything on the horizon which is going to indicate a much more aggressive Fed to the upside. But we certainly have to respect the way the technicals have worked, and the 0.382 and the 200-day moving average have combined to catch the lows in the 5-year note and tell us that the next move is up in yield. If we look at the 10-year note, much the same is evident, although less so, as it broke the 200-day moving average for a few days and tested the 0.382 retracement. That tells us that the overall trend for the yield curve is still one of flattening. 10s and 30s are better bid than 2s and 5s over the long term. We think now this area around 232 in yield is going to be very crucial. If we break above the 232 area, we shall probably trade around 250 before we can calm down in terms of yields. So certainly the upside is favored, but we don't think it's going to go very far, probably maximum of 15 to 20 basis points from here. Still quite a large move, but 232 here is going to be key. If we break above it, 250 should be seen, and that would be a good level to get long of futures again for a move back down into the around the 210, 220 area. We think this area will be revisited at some stage. We don't think it goes straight up from here. There are no indications that the US economy is strengthening that much, but certainly there is pressure on the yield curve, and that has to be respected. In our opinion, the US fixed income market was actually accelerated by what is happening in the EU fixed income market. As you know, last week there was intense speculation that the ECB would start tapering sooner rather than later, and that has led to a lot of pressure on EU bonds, not surprisingly, since they are mostly trading in negative territory. This is a weekly chart of the Schatz, the 2-year in Germany, and you can see that the trend has been higher for several weeks. It cannot break and close through the Bollinger Bands of the weeklies, although it is trying to do that on the Bollinger Band on the dailies, but you can see how it just there is just not enough pressure, because the certainty is just not there. There have been so many false starts and so much talk of tapering from the ECB, and so much speculation about it, that we're not really surprised. There has to be something from Draghi something quite specific from him before that move starts becoming irreversible. This is a monthly chart of the shats, and you can see that we have room to minus 37 from minus 57, so we have room for another 20 basis points higher before the technicals tell us that this is overdone. But if we look at 5-year notes, on the monthlies, we can only move another 7-8 basis points to minus 13, and we're trading at minus 22 now. If we look at the weeklies, we are very much against the Bollinger Bands, and if we look at the 10-year notes, this is the Bund, this is the monthly, we can see that we have moved to 63 basis points. From now we are at 46, and if we look on the weeklies, we will actually see that we are very close to all these very important levels around 50. It is going to take a very big effort to close the Bund above 50 basis points and to maintain it there. And really, if it goes to 50, it'll go to 62, and then we think it'll come back. We don't think that this is the start of the big adjustment in EU yields, simply because we don't think there will be the willingness from the ECB to let that happen. That would imply a move in the euro USD to much higher levels, probably above 120, and we just don't think there is any willingness from these guys to let that happen anytime soon. The moves in European bonds last week actually had their effect even on Japan, and you can see that the Japanese bond, which they are, the Bank of Japan is targeting to be around zero, spiked all week because of the pressure on Europe. Well, we are quite convinced that the Japanese next week will intervene and drive this yield back down towards zero, which will actually probably cause the European markets to come back as well towards the middle of the Bollinger Bands, and that will be our chance to get very short of them, because this is just the first move that will happen. If we can now see this market panic back towards the 35 level in bunds, we think that the next move into the autumn is going to be much higher. But this, we think, is a false break, a false initial move before the market retests these lower levels and then goes. This is a chart of the Bund, a weekly chart of the Bund, which we don't really like looking at because there are all these moves which are caused by the rolls, and therefore they're not true levels because the cheapest to deliver keeps on changing. But they do give you an insight into the overall trend. We think that the market could easily trade down towards the 160 area in the next week or so. If that happens, we think it's a great level to buy calls for another move back up towards 163, where we will be buying a large amount of puts, looking for the market then into the autumn to start falling towards the 150 level and the 1% yield level in the 10-year Bund. But we don't think the move is going to be that simple. We think the ECB will come out with some statement. We think that the Bank of Japan is going to come in with intervention, and that the fixed income market will stabilize at higher levels for the summer before making a move in late autumn to the downside. One of the main reasons why we don't think the Bund can go much higher in yield over the very short term, maybe 10 basis points or so, is the situation in the euro USD exchange rate. We think that the market needs a period of several weeks of consolidation before it is ready to move to higher levels. It needs to churn at between 116 and 112 before it's built enough of a base to turn these moving averages and starts working higher. That doesn't mean that we particularly want to go against the trend. It just means that we don't think the trend is going to be strong enough yet to carry prices much higher. We don't think it's in anyone's interest at the moment to, certainly not in the ECB's interest, to allow that to happen, and that they will fight it at the between 115 and 117 area, because if it trades above 118 we are well and truly gone, and we could be going back up towards 125, 130 very quickly. We don't think they will allow that to happen. We think they will hold it just like they held it here for at least a couple of months before they are ready to allow it to move higher. But certainly we think the trend in Euro USD is turning, and that we have seen the lows. We have no reason to believe that over the course of the next 2 or 3 years we won't be significantly higher in the Euro USD exchange rate. The most interesting opportunity we think we're going to get in the next week or so is actually in the stocks, and this is a cash weekly market of stocks. The very important break levels that we warned you about on the upside now become support on the downside, 33.25 to 32.86. Well, that is not so far away from where we closed. Certainly below 3400 we want to start building longs. We are going to have huge support here just above 33.25 in the next couple of weeks. So the major opportunity we think is going to be in the stocks between 33.25 and 33.60-70, and that is going to be the level that we think we will be able to pick up stocks and sell bunds and bobble for the long term, looking for new highs in the stocks and new lows in bunds. That is what we certainly wish to do over the course of the next couple of weeks. That's going to be the most important position that we want to hold for the long term. And why we want to hold that position for the long term is explained here. This is SPY over FEU. As you can see, we warned you when it broke the 200-day moving average. The 50-day moving average broke as well. It is now, as we thought, retesting it from the downside. It will trade around here, but we think that this trend, which has lasted over a decade and then accelerated, is probably over, and that we are due to retest levels around 6 over the course of the next 2 or 3 years. So we really want to be long of European equities and short of European fixed income for the very long term, which makes sense. If they do taper, that is because the economy in Europe is doing better. If the economy in Europe is doing better, equities should be more expensive, not less expensive. And since European equities are much, much cheaper in terms of valuations and PEs than US equities, it makes sense to exit an area which has been performing very well, i.e. the US, and transfer your money to areas which are only now beginning to do better. The one major opportunity in spreads in the US that we can see, because the US market is dead but we think it has a downward bias still. We still think that the 2380 area will be revisited at some stage before we move higher again. But the US market is not interesting per se as much as the spreads are interesting. This is XLK, so technology over SPY. As you can see, it's doing a beautiful ABC retracement to a level which is very important, which is also being caught by the 200-day moving average, which is going higher, and that level is 0.22328, which we will tweet when we get to, and that is going to be the area where we want to get long of technology stocks after this dump in technology, correction, whatever you like to call it, for the next move, which we still anticipate will be higher in technology against everything else. Very significant level coming up in the next week or so, and we want to have a very good high risk reward position long XLK over SPY when we reach this point. Much the same can be seen in the QQQ, again the SPY, again QQQ is quite technology heavy. We have a one more leg down, which could be a good 2 or 3% relative to the SPY, and people might start panicking, and when we reach just below this area around 0.554, that is where we want to get well long of the Qs for yet another move higher. The trend is very much supportive. The 200-day moving average is well going, got a lovely slope. Any tests of these levels, certainly we shall get at least a bounce, if not the beginning of a big move higher. As far as all our spread indicators are concerned, there is absolutely nothing showing that any move in equities can be anything more than a small 3, 4, 5% correction, rather than the beginning of a bear market. Absolutely nothing. None of the spreads that we look at are, and that we covered in detail last week, from from the ratios between TLT and XLF, all the other ratios that we mentioned last week, none of them are showing any signs of the market being ready to take a major move lower. In fact, if anything, all this week they have improved. This is SPY over TLT. We still are getting higher readings and moves higher, implying that money is flowing into equities and out of bonds. Therefore, there is absolutely no reason, again, to believe that anything is happening under the hood of the market that is troublesome. Even credit, which broke down, has come back. This is HYG over TLT. We think it will go back down, and we are quite happy to be short of it. But that is also something which is saying that whatever is going to happen in the outrights in SPY, SPX and ES is just a correction. We still think that 2380 trades, and certainly volatility gave us that hint, but we think whatever that any bear market is many months away, and unfortunately we are more likely to get a grind higher out of equity indices than anything else. Before we finish, just a quick word about volatility. Volatility was very interesting to trade last week and great fun. We didn't get overexcited by it, and we have long-term options for a very simple reason, because we think this kind of behavior is going to continue. This is XIV, so the opposite of VXX, which we find much easier to analyze technically. Until we break and close this 50-day moving average, and the Bollinger Bands, at least on the dailies, if not on the weeklies, we think nothing has changed in terms of volatility. It is still going down with these amazing spikes every few weeks, which are actually incredibly profitable if you have an options position and you can take advantage of them when they happen. And that is why we have an option position as opposed to an outright position, because the option position with deep in the money, well, here it would be puts. We have calls on the VXX, allows us to hedge our position 1 to 1 when these spikes happen and ride the whole thing back up there. So it ends up that our call position becomes free. So this is going to be very interesting, and do not think that anything is going to happen here until we turn that trend. That trend is definitely not turned. Let's format this into a weekly so you can see what is actually happening under the hood. You can see how this is not a change of trend. It is just bouncing around, but the trend needs to change via closes below this point where it touched last week. This is going to take many weeks. So don't think that the volatility is giving you any clues that this what is going to happen in the very short term. We actually think that volatility is telling you that nothing is going to happen in the very short term. The This probably last week was a dress rehearsal for a move that will happen a few weeks from now when the market breaks lower, but it's going to take a long time to change this trend in volatility. This, remember, is XIV, so the opposite of VXX. You can be short of volatility on spikes without any problem. We don't see that this is going to turn, certainly not in the next few weeks. And if you have a look at one of our favorites, which is the index itself against the spread of volatilities short against long, it's in no man's land. It's telling you the market is churning. It might well churn and fill again this gap that it has around the 2370 area. We would not be surprised to see that happen, but overall we are still waiting for one more leg higher, which we think is going to take it to above 2500 by the beginning of the autumn. Finally, our biases for next week. 232 we will watch in 10-year notes, very important level. We would be surprised if the market is strong enough to go through it. Let's see, let's give it the certainly respect that level. Bund and Bobble, is it a false start? We certainly think it's a false start in terms of higher yields. The closes above here, 161, sorry, 161.75, have to be respected, but we don't think that it goes any lower than 160, which was that yield level around the 0.62% that we showed you earlier. So 161.75 closes below that probably take you down to 160. 160 is a great level to pick up some call spreads on the upside, which should make money, and then only then you will be able to put on long-term positions short of Bund futures, looking for higher yields. Yes, we would not be surprised still to see a 3-4% range. The most interesting thing to happen is going to be the XLK spreads, which we think are coming in the next couple of weeks to buying areas. The Russell 2000 is the one that actually giving you a clue that there is very little weakness in this market. The Russell 2000 is toying with new highs, and we think over the course of the next couple of months will be significantly higher, dragging the indices all back up. European equities, as we mentioned, we're looking for this famous dip to that 33.25, 33.75 area. If we get down there, we want to be major buyers. DX, we hate DX, and we've hated it for months. We've hated it from before Trump came to power. We think that DX will go significantly lower, but we don't think the timing is now. So we're probably being pigs, but what can you do? And yes, short bobble, shats, long stocks is here, but we need another 2 or 3% in that relationship before we are very comfortable putting it on for the next 3, 4, 5 years. Thank you very much indeed, and have a wonderful Independence Day in Canada, in the States, and we'll speak to you on Monday.